Welcome to the Opening Bell Report.
And we're talking about a very specific drop today. 26%.
Overnight.
Just gone. That's what happened to Unity Software not too long ago. Their earnings report came out and the market just, it treated it like a crime scene. Pure panic.
It was a bloodbath.
Yeah.
Really. If you were just scrolling headlines, looking at social media, the whole narrative was apocalyptic.
Right.
People were shouting that the ad business is broken, that, AppLovin is eating their lunch, AI is going to kill game engines. Basically, that Unity is uninvestable.
Uninvestable. That's a strong word. But that's exactly why we're doing this deep dive. We've got this analysis report in front of us that looks at all that wreckage and says, hold on a second.
Mm-hmm.
The thesis we're going to unpack is called the contrarian value thesis.
Exactly. It's the classic baby with the bathwater scenario. And the whole mission here is to explore why the market might be, I'm just dead wrong about this.
Okay.
Because the core argument in this analysis is fascinating. It says the market has priced Unity for bankruptcy.
For zero.
Right at the exact moment the company delivered its most profitable quarter in its entire history.
See, that feels like a huge disconnect, doesn't it? I mean, usually when a stock is priced for doom, the company's bleeding cash. But you're telling me they're actually making money.
They're printing it.
Yeah.
And that right there creates this massive opportunity. If you could just look past the scary headlines for a second, we're going to get into the valuation reset, the cash flow safety net, which is huge,
Yeah.
and the competitive moat that I think everyone just forgot about in the panic.
I think we have to start with the price. Because to really get where we are, you have to remember where we, came from. Remember 2021, the metaverse hype?
Oh, vividly. The everything bubble.
Yeah.
I mean, you had companies with literally zero profit trading at these insane valuations.
Yeah.
And Unity was the poster child.
It was the golden child.
Yeah. Back then, investors were paying 40 times sales. 40.
We'll just sit with that for a second. 40 times sales. So for every dollar of revenue Unity made not profit, revenue people were paying $40 for the stock.
It was total euphoria. And here's the kicker. Back then, Unity was losing money. Hand over fist. They were burning cash just to grow.
So you paid a luxury price for a money-losing business, all based on a story.
A story about the future.
Yeah.
Exactly. So fast forward to today. Stock crashes 26%. Where does that leave the valuation now?
It's got to be lower.
It is a complete reset. Today, Unity is trading at around 4.5 times sales.
From 40 down to 4.5, that is just vital.
It's a crash.
Yeah.
But here's the nuance the market is missing, and this is where the analysis gets so interesting. If you look at the stock price today, it's basically back to where it was in 2020, a full round trip.
So back to square one, price-wise.
Yep, so stock price is back.
Yeah.
But the business itself, it is a completely different animal.
How so?
Well, for starters, the revenue is 3 times higher. We're talking about a company on a $1.5 billion run rate today. Back in 2020, it was maybe $500 million.
Okay, so let me get this straight. The stock chart says nothing has changed in 4 years. But the business says we are 3 times bigger.
That's it. That is the value disconnect. The research here argues that the risk of multiple compression, that's just Wall Street talk for the valuation shrinking, it's gone. It's already happened. You're not buying a dream anymore. You're buying a piece of critical tech infrastructure for like a utility company price.
It's like buying a mansion for the price of a shed just because the neighborhood had a bad week.
That's a pretty good analogy. But, and this is a big but, a cheap house is still a bad investment if the foundation is rotting.
Right. And that's the bear case.
It is. They think Unity is going to run out of money or that the whole business model is broken.
Which brings us to the safety net part of this analysis. You said they were burning cash in 2021. If they're still burning cash, then a cheap stock doesn't matter. They'll just go bust. What do the books actually say?
Okay, so this might be the single most important number in this entire deep dive. This is what separates the zombie companies from the real businesses. Free. Cash. Flow.
Okay.
In the fourth quarter alone, Unity generated $119 million in free cash flow.
Wait. In 1 quarter.
One single quarter. They put $119 million in the bank after paying every single bill. If you project that out for a year, you're looking at an annualized FCF of over $400 million.
Okay, so that just kills the bankruptcy argument right there, doesn't it? Companies that are generating $500 million a year in cold, hard cash don't just disappear.
They do not. And what this shows is a massive pivot from management. For years, Unity was run like a classic Silicon Valley startup, right? Growth at all costs.
The blitzscaling model, yeah.
It's exactly. Burn money, get users, worry about profits. Maybe never. That era is over. The new management, they've cut costs, they've laid people off, they've closed unprofitable ventures, and they've expanded their EBITDA margins to 25%. They're focused on efficiency now.
So they grew up, they stopped acting like a teenager with their parents' credit card and started acting like a real business.
And that maturity gives them options.
Yeah.
This is so key. When you have a pile of cash like that, you are in control.
Yeah.
You can buy back your own shares, which helps the stock price, or you could go acquire some smaller AI tools to plug any gaps in your tech. You have breathing room.
Okay, so the valuation is low, the bank account is full, that's the financial floor. But what about the product? None of this matters if developers are, leaving in droves.
The moat. This is the part of the story I think people really underestimate.
The report calls Unity the Excel of game development. It's a really sticky comparison.
It's powerful because it's true. Think about Excel. Everyone complains about it, right? But the entire financial world runs on it. You can't just decide to stop using it one day. Unity's in a similar spot. The stat in the report is just staggering. Something like 70% of the world's top 1,000 mobile games are built on Unity.
70%?
Yeah.
That's a functional monopoly on mobile.
It is. But the bear argument, the fear, is that developers are going to leave. They'll get mad about some pricing change like the runtime fee disaster last year, which, let's be honest, was a PR nightmare, and they'll jump to Unreal or Godot.
Which sounds totally plausible on Twitter, right? You see devs saying, that's it, I'm out, and it feels like this huge exodus.
It feels that way. But the analysis really stresses the idea of switching costs. Imagine you're a studio with 100 people. Your entire pipeline, your tools, your asset libraries, everything. It's all built around Unity.
It's not just the code, it's the whole workflow. Muscle memory.
Right? To switch engines is not like switching from Uber to Lyft. It's like deciding your whole company is going to switch from speaking English to speaking Mandarin while trying to finish a project. It takes years. It costs millions in lost productivity.
But even if they're angry, they're stuck.
They're sticky. Unity is infrastructure. It's the plumbing in your house. You don't rip out all the pipes just because you had a fight with the water company. You grumble, you pay the bill, and you move on.
But what about the new threat? The report mentions Project Genie, Google's AI. The story goes that soon you won't need an engine. You'll just tell an AI, make me a game, and boom, it's done.
This is the existential dread part of the conversation. And yeah, the analysis hits it head on. It's a valid concern for, the far future. But for right now, professional studios need granular control.
What does that mean, granular control?
It means if you're making a massive game, you need to tweak the lighting in one specific corner by 10%. You need to adjust the jump physics by 3 milliseconds so it feels right. Gen AI is great at making the assets, the picture of the cat, the model of the robot. It's terrible at the structure that holds it all together.
So it can write a poem, but it can't lay out a magazine.
That is a perfect way to put it. You still need the engine to assemble the pieces. The engine isn't the painting, it's the gallery where you hang it.
Okay, let's get into the messy stuff, the bear case. Because this report, even though it's bullish, admits things aren't perfect. And the big monster in the room for Unity is a company called AppLovin.
Yes, AppLovin. They are the elephant in the room. And to be fair, they have been performing incredibly well.
The narrative is that AppLovin is just eating Unity's lunch in the ad business. And for anyone listening, Unity makes money selling the engine and also running ads inside the games made with the engine. And that ad business is struggling.
The report concedes this point right away. It basically says, yep, true, AppLovin is winning right now. Their AI algorithm is just performing better, so developers are moving their ads to AppLovin because they make more money there.
So if their competitor has a better mousetrap, why is this report bullish? Why would you buy?
Because of the structural difference between them.
Yeah.
This is key to the whole contrarian idea. AppLovin owns the ad network. Unity owns the ad network and the engine.
And why does owning the engine matter for selling ads?
The data. First-party data. Think about it. AppLovin sees that you clicked an ad. Unity sees everything. They know how long you played level 1. They know you got stuck on the boss. They know you play every Tuesday at 8 p.m. They know how you play, not just what ads you click on.
That's a way, way richer data set.
Infinitely. The argument is that Unity has just been clumsy integrating this data, especially since they bought IronSource. It's been clunky. But theoretically, once they fix that, their ad targeting should be better.
So AppLovin is winning the sprint, but Unity has the potential for the marathon because they own the whole track.
That's the thesis. It's not a guarantee, but it's a logical path back. They don't have to win tomorrow. They just have to stabilize and use that data advantage.
Let's circle back to AI. We talked about it as a threat, but the report actually flips it and says there's a big bull case for AI helping Unity. How does that work?
Okay, think about how hard it is to make a game. The barrier to entry is super high. You need to code. You need to be an artist, a designer. It's really, really hard.
It's daunting. I've tried. I think I lasted 3 days.
Exactly. But what if AI tools can generate the code snippets for you, or create the art, or write the dialogue? It just lowers that barrier to entry way down.
So more people can start making games.
Millions of new creators. And if they're using AI to generate the pieces, they still need Unity to put them all together and get them on an iPhone. More creators means more seats, more software licenses for Unity.
So instead of replacing the engine, AI just becomes this fuel that lets way more people use the engine.
Precisely. It democratizes the whole thing. And since Unity is the default, the Excel of the industry, they capture a huge chunk of that new volume.
I want to touch on one more complaint, the growth. Analysts say Unity is a zombie. It's only growing at 10%. In tech, that's basically standing still.
And that goes right back to the valuation we started with. The report argues that, look, 10% growth is perfectly fine if you're paying the right price.
And at 4.5 times sales, that's the right price.
Or look at it through earnings. At this price, it's trading at about 18 times EBITDA. When a stock is that cheap, you don't need 40% hyper growth to make money. You just need stability. If they just grow at a boring 10%, the stock is still cheap.
It's about managing expectations. You're not looking for the next NVIDIA. You're looking for a solid utility that got oversold.
That's it. You win when the gap closes between perceived disaster and boring reality.
Okay, let's talk about that gap. The report brings up the technical setup, the gap fill. What are we looking at?
This is pure market psychology on a chart. When the stock crashed, it gapped down. It went from $29 to about $21.40. It just skipped all the prices in between.
And markets hate leaving those empty spaces.
They do. Gaps caused by pure emotion, like this panic selling, they tend to fill as logic comes back into the market. The price just sort of drifts back up.
So just a return to where it was the day before the bad news hits.
That alone is a 35% upside from the lows. You don't need a miracle. You just need the panic to stop.
The report also talks about institutional flows, the whole smart money versus dumb money thing.
Well, when you see a drop with that kind of massive volume, that's usually retail investors and panicked funds just dumping shares.
Yep.
The report suggests that smart money, the institutions, they start accumulating when that volume dries up. They see that $18 to $20 range as a buying zone.
They're picking up the shares that the panic people are throwing away.
They're looking at the cash flow statement, not the headlines. They're asking, is this business going bankrupt? The answer is no. Is it cheap? Yes, it is.
So let's wrap this up with the final verdict. The report frames this as an asymmetric bet. What's the actual risk versus reward here?
Okay, this is the bottom line. Downside risk. Let's say it gets worse. They lose more ad share, growth goes flat. The stock probably drifts down to its historical support around 15 to 18 bucks. So you're risking, what, 15 to 20%?
Okay. Painful, but not a wipeout.
Right. Now, the upside potential. The ad business stabilizes. Their AI tools get some traction. The market wakes up and says, hey, this is a cash flow positive monopoly. The stock re-rates to something normal, like 6 times sales. The price goes to $35 or higher. That's a reward of 70%.
So you risk 20% to potentially make 70.
That's the asymmetry. The odds are tilted in your favor if you can just stomach the fear.
So the final word from the analysis is, buy the fear.
That's it. Because, as the report concludes, the engine is a monopoly, the cash is real, and the price is wrong.
It's a compelling argument, and it really shows the difference between investing and just following the herd. It's scary to buy when everyone is screaming sell.
It is. It goes against every survival instinct we have. But great investing often requires you to do just that when the facts contradict the sentiment. The data is the anchor.
It reminds me of that old Ben Graham quote, in the short run, the market is a voting machine, but in the long run, it is a weighing machine.
Spot on. Right now, people are voting with their fear. But eventually, the market has to weigh that $400 million in cash flow, and cash is heavy.
So here's the question for you listening right now. When you see a headline screaming crash, what's your first move? Do you sell, or do you open up the financial statements and look for that disconnect?
Are you buying the business, or are you just trading the noise?
That's the question to sleep on. Thanks for joining us for this deep dive.
My pleasure.
We'll see you next time.
Don't forget to like, share, and subscribe for more.